Shane, why don't you put two and two together for me? From what you're hearing from China, what do you think about the economy and where it's going?
The economy is clearly slowing, and I think the reality is that what is going on in Wenzhou is consistent with Chinese monetary tightening over the last year or two really starting to bite. And I think that with the economy slowing down, exports slowing, inflation figures tomorrow I think will confirm the view that July marked the peak in China's inflation rate. All of that, I think, is pointing towards some sort of monetary policy easing by year end. I mean, so far they've started to ease up credit conditions for small businesses, partly because of those problems in Wenzhou, but I think we'll see something more broad-based by year end.
Shane, it's Rish in Hong Kong as well. We're joining Sue. How bad can things get in China? I have a guest earlier, Diana Choi Labour from Lombard Street Research, really talking about the authorities just being way behind the curve and that things are drastically slowing down and much more than people have anticipated.
That's quite possibly the case, and there are some indications of that things have slowed down a lot more than they did, say, prior to the 2008 financial crisis at the time. And I think what's happened this time around is that the authorities have probably been a bit more focused on inflation than was healthy. They haven't seen the slowdown coming through on the back of tight credit conditions and also the slump which has occurred globally, particularly in Europe and the US. So I think right now I'd say the Chinese authorities are behind the curve. I think they need to get their eye off inflation and onto what's happening in the real economy. I'm pretty confident they will, but obviously if we don't see an easing sometime in the next few months, then we could see Chinese growth slowing below the 8% level. I wouldn't see it going much below that, maybe down to 7%. But as I say, I think the more likely scenario is that China will ease by year end, and then the real threat to Chinese growth will be what happens in Europe and the US.
What do you think about Chinese equities? Because we've had a rally in Shanghai for, say, I think 4 days so far this week, based on expectations that the government will step in to try to prop up equity markets, like they did with the banks, right? With the central state-owned investment firm Huijin doing that. What do you think of this belief, and what do you think of Chinese equity markets as a whole? Is there compelling value there?
I think there's compelling value there, and I must say I've thought that for the last few months now. It hasn't stopped the market going any lower. But my feeling, though, is that the market did go down, retest those sort of lows we saw last year, and I think we're getting pretty close to the end of the bear market, if not having seen the end of the bear market in Chinese shares. I think given the fact that shares are trading on very attractive price-to-earnings multiples, I think that the forward price-to-earnings multiple is now just below 10 times. Even on historic earnings, we're well below longer-term averages, which is for a PE of around 30 times. We're now down around 15, I think the number is. So on those sorts of valuation measures, the Chinese share market is looking quite cheap. What has to happen is that China needs to see some sort of easier macro policy going forward, and I think the government's starting to signal that. But obviously they need to do more. But my broader view is the Chinese share market has probably bottomed, or if not close to it, and we'll see pretty good gains over the next 6 to 12 months.
Shane, I mean, as Susan mentioned, you know, with the move to buy those shares in those banks, I mean, was that not just the signal to everybody that the authorities are putting a bottom on this market?
Well, I think that's precisely right. I mean, I guess there's two interpretations of those sorts of actions. The negative one is that, well, China really has a major problem here, otherwise the authorities wouldn't be intervening in the bank share market. And the other one is that, you know, this is actually a positive, that the Chinese authorities are starting to take notice now. They've obviously taken notice of what's going on in Wenzhou, and I think they've taken notice of what's going on in bank shares. So that suggests to me that we are heading towards some sort of change in policy in China, and that the authorities, as you say, are trying to put some sort of bottom on Chinese share prices.
Before we went to break, you were talking about how the government in China is putting a floor, a bottom to Chinese stocks, but you don't think equities around the world have bottomed just yet?
Well, I mean, the problem with equity markets is that in the last couple of months we've had several bounces, and of course they've proven to be false, and of course you know, there's still a lot of uncertainties regarding what's going on in Europe and the US. What I will say, though, is that the action we've seen in the last week or so is fairly positive. You'd have to say that the fact that the markets have been able to push on, that we didn't see a further breakdown last week when the markets did go to those lows on Monday and Tuesday. All of those things I think are quite positive, and it's also the case that historically when you go back and look at market bottoms, they often come at a time when things are still pretty uncertain globally. So at this stage I'd say I'm cautiously optimistic. I think the key for investors is to look at any pullback, and it's inevitable that sometime in the next few days we're going to have a bit of a pullback in markets, particularly after such huge gains from the lows early last week. Assess how strong that pullback is. If the pullback is only mild, that would suggest that the pattern we've seen over the last couple of months is now being broken, and that we might push on to new highs. One of the things that a couple of things that give me optimism, I guess, over the next couple of months is that historically the September quarter is the worst quarter of the year, the December quarter is normally the best quarter of the year, and October often marks a turning point. So if history is any guide, then if we haven't seen the low, then it's probably going to come this month anyway, and therefore investors should start to position for some sort of rally going into year end.
Okay. You know, though, Shane, we have a lot of people saying that these gains are building upon themselves day after day because of people covering their shorts. This is just a temporary short squeeze. Do you think that's happening in the markets, though? You can't discount that theory, I guess.
Well, I think that's certainly quite possible that what you're seeing is just a short squeeze, but then you could say, well, we've seen other gains over the last couple of months which have been 8%. Some of them have been up to 8%. And of course they weren't sustained, particularly in the US share market, and of course they're all short covering rallies. Typically when you go into some sort of bear market or investors get very negative, a lot of investors have short positions, so therefore if the news is less bad or better, then of course you get the short covering rally. The only problem is that every time markets bottom in the bear markets, people always say it's a short covering rally, and then eventually it goes on to become something else. So sure, a lot of the strength has been investors covering their shorts. That's why I think the key here is to look at any pullback in markets that we'll probably get in the next week or so, see how deep that pullback goes, and whether investors then come in again and keep pushing it higher. If they do, then I think that's a positive sign.
Okay, Shane, well, let's talk about where there's value in the market. You said China has compelling value, but what about elsewhere in the world, considering, you know, look at these employment figures that we got from Australia today, twice the figure expected by economists, and yields, by the way, are up at 7% for Australian equities.
That's right. There is a lot of value out there. I must admit, as an economist who forecasts these numbers, they are very hard to get right. From month to month. The previous month the figures were a lot worse than expected, so this month you see a bit of a pullback. But the underlying picture in Australian labour market is one of softness. We've seen a loss of 5,000 jobs over the last 6 months, so it's certainly softened. But I think the equity market, by the same token, has largely factored that in. The 20-odd% fall in equity markets from their highs back in April to the recent low largely factored that in. Even if you allow for the recent bounce in markets, you get pretty good yields. From many Australian shares, the overall dividend yield on the market is about 5%. Banking stocks and some of the financials, you're pushing up to yields of around 8-9%. So there's quite a lot of value in parts of markets around the world, even if you've still got a cautious view on the economic cycle.